You check your portfolio every morning before you even brush your teeth. The number is down again, and without thinking, you close the app. But that instinct, that flinch, is costing you more money than almost any bad trade you have ever made. Here is what nobody tells you about investing. The single greatest threat to your financial future is not inflation. It is not market crashes. It is not bad timing. It is the 6 inches between your ears. And the reason your brain reacts to a falling stock the exact same way it reacts to a lion charging at you is not a glitch. It is a feature. One that kept your ancestors alive for 200,000 years, and one that is silently destroying your portfolio right now. To understand this, you have to follow the money from the ancient savanna where human survival wiring was built, all the way through the laboratory experiments that proved it, then into the hidden cost buried inside every panicked sell decision you have ever made, and finally to the small, almost laughably simple shift that separates the investors who build wealth from the ones who just watch it disappear. Chapter 1. The Threat That Never Goes Away. This chapter starts where your brain starts, in the past, not the recent past, the ancient past. Think about where your nervous system was designed, not in a brokerage account, not in front of a glowing screen. Your brain was built on a savanna under constant threat from predators, drought, and starvation. In that world, the most dangerous thing you could do was ignore a threat. Hesitation got you killed. Speed saved you. So your brain built a shortcut, a tiny almond-shaped structure deep inside called the amygdala. It is always watching, always scanning. And the moment it detects a threat, any threat, it fires before your conscious mind even knows what happened. Your heart rate spikes, your muscles tense, cortisol floods your bloodstream. Your vision narrows to the threat in front of you. This is the threat response. It is fast, it is automatic, and it evolved to handle lions. The problem is that your amygdala cannot read a brokerage statement. It cannot tell the difference between a lion in the grass and a red number on a screen. Both register as threat. Both trigger the same cascade. Both demand the same response. Run. Get out. Make it stop. The market drops 3%, and somewhere deep in your nervous system, your ancient survival wiring concludes that something is trying to eat you. Chapter 2. The Experiment That Named the Enemy. In 1979, two researchers changed the way we understand financial decision-making forever. Their names were Daniel Kahneman and Amos Tversky, and what they discovered was not what anyone expected. They were studying how people make choices under risk, and they found something that broke the logic of traditional economics. People do not weigh gains and losses equally, not even close. Losing $100, they found, produced roughly twice the emotional impact of gaining $100 produced pleasure. Twice. The pain of loss is not equal to the joy of gain. It is far more powerful. Kahneman and Tversky called this loss aversion, and it became one of the most replicated findings in behavioral economics. They would go on to win the Nobel Prize. But the number that matters is not 100. It is the ratio, roughly 2 to 1. For every dollar your portfolio drops, your brain generates approximately twice the emotional suffering that it would generate joy from the same dollar going up. Run that through a volatile market week. Up 2%, down 2%, back up 1, down 1.5. Technically, you might be nearly flat, but emotionally, your brain has been pummeled, and a pummeled brain makes impulsive decisions. This is not a character flaw. This is not weakness. Kahneman and Tversky were not describing broken people. They were describing all people, you included. The wiring runs deep. Chapter 3. What the flinch actually costs. Here is where the story moves from psychology to money, from theory to your account balance, because loss aversion does not just feel bad, it has a price tag. Terence Odian, a finance professor at UC Berkeley, spent years pulling apart the actual trading records of individual investors. Not simulations, not surveys, real trades. What he found was devastating. Investors consistently sold their winning stocks too early and held their losing stocks too long, the exact opposite of what rational investing demands. Why? Because selling a winner locks in pleasure, selling a loser locks in pain. And the brain will twist itself into knots to avoid pain. The result was a pattern Odian called the disposition effect. Investors were, on average, 68% more likely to sell a stock that was up than one that was down. They were holding their losses and releasing their gains. And every time they did that, they were slowly bleeding returns. Then there is the panic sell. The moment fear becomes unbearable and you dump everything. Studies of investor behavior during market downturns show a consistent pattern. The people who sell during a crash overwhelmingly sell near the bottom, then wait, then buy back in near the top. They crystallize their loss. They miss the recovery. And they do it again and again, convinced that this time the market is really, truly done. J.P. Morgan ran the numbers on what missing just the 10 best trading days of the S&P 500 over a 20-year period would cost an investor. Just 10 days, out of roughly 5,000 trading sessions. The answer was that you would cut your returns nearly in half. 10 days. Your amygdala does not know that. It just knows it hurts. Chapter 4. The Investor Who Learned to Sit Still. Not everyone falls into this trap at the same rate, and the investors who escape it are not smarter. They are not wired differently. They have simply learned something that feels deeply unnatural. They have learned to treat discomfort as information rather than instruction. Warren Buffett has said, in various forms, that the stock market is a device for transferring money from the impatient to the patient. That line has been repeated so many times it has lost its weight, but read it again slowly. The market is a device. It is doing something intentional, and what it is doing is taking money from people who cannot tolerate short-term pain and giving it to people who can. Buffett held Coca-Cola through crashes. He held American Express through scandal. He held Washington Post through years of underperformance, not because he felt nothing, because he understood that the feeling is not the signal. The feeling is the noise. The research of psychologist Brad Klontz, who studies the emotional relationship people have with money, found that what separates successful long-term investors from reactive ones is not knowledge of financial instruments. It is their relationship with uncertainty. The investors who outperform are the ones who have developed what Klontz calls money tolerance, the ability to remain in an uncomfortable financial position long enough for it to resolve in their favor. That is not a market skill. That is a psychological one. Chapter 5. Rewiring the Response. You cannot remove the amygdala. You cannot override evolution. But you can build systems that create enough distance between the threat signal and your action to let your prefrontal cortex, the rational, long-term planning part of your brain, catch up and weigh in. The simplest intervention is also the most counterintuitive. Stop checking. Not forever, but researchers at the University of Chicago found that investors who checked their portfolios less frequently not only experienced less anxiety, they made better decisions and earned higher returns. The act of checking triggers the threat response. The more you check, the more often you experience loss aversion. The more often you experience it, the more likely you are to act on it. Set an investment policy statement before the next downturn. Write down, in specific terms, what you own, why you own it, and under what conditions you would sell. Do this while the market is calm and your prefrontal cortex is in charge. Then, when the red numbers start, you have a document written by a version of you that was not under threat. You let that version make the decision instead of the one whose hands are shaking. Automate what you can. Dollar cost averaging, putting a fixed amount into the market at regular intervals regardless of price, removes the decision entirely. When the market drops, your automated contribution buys more shares at lower prices. Your amygdala never gets to vote. And reframe the label. When your portfolio drops, your brain labels that event as loss. But if you still hold the position, no loss has been realized. You are not looking at a loss. You are looking at a price change, a temporary valuation. The loss only becomes real the moment you sell. That reframe is not just semantic. Studies using functional MRI imaging show that the way you label a financial event changes the neural response it triggers. Label it as a loss and the threat response fires. Label it as a fluctuation, and the brain processes it differently. You are not changing the market. You are changing the story you tell your nervous system. Chapter 6. The Quiet Cost of Staying Afraid. This is where the numbers get real, not for the hypothetical investor, for you. Assume you invest over a 30-year career. Assume the market returns its historical average of roughly 7% annually in real terms. If you stay invested, if you never panic sell, if you never miss those 10 best days, compounding does something extraordinary. A $10,000 investment becomes roughly $76,000. Now assume you are a typical reactive investor. You panic sell during 2 major downturns. You stay in cash for 6 months after each one, waiting to feel safe before re-entering. You miss some of the sharpest recovery days. Your real return drops from 7% to closer to 4%. That same $10,000 investment becomes roughly $32,000, less than half. The difference between those two investors is not knowledge. It is not access. It is not wealth. It is the management of a biological response that was never designed for modern financial markets. You cannot think your way out of emotion, but you can build structures that keep the emotion from pulling the lever. Every morning you check your portfolio before brushing your teeth. You are handing your amygdala a loaded weapon and hoping it does not fire. The investors who build real wealth have taken the weapon away, not by becoming emotionless, but by understanding that the flinch, that deeply human, deeply wired response to loss, is the most expensive reflex you will ever have, and by building a life and a portfolio designed to survive it. You check your portfolio every morning before you even brush your teeth. The number is down again. And this time, you understand exactly what that feeling is and exactly why you should not let it decide what you do next.